The esteemed executive, colleagues, and our distinguished guests, ladies and gentlemen, I would like to thank you for joining us at Fintech Week in Istanbul. I would also like to thank the organization committee of this valuable meeting. Today, I have the privilege to make a keynote speech about the regulatory experience of Turkey regarding the crypto assets. As Arkan said, financial technologies, with no doubt, is reshaping the landscape of the financial markets. Of course, this also reshapes how we conduct transactions, manage investments, and engage in the financial ecosystem. As we welcome these innovations, it's also important to address the regulatory aspects that govern the financial ecosystem. The integration of fintech into the capital markets represent both opportunities and challenges. On the one hand, technologies such as blockchain, artificial intelligence, and automated trading platforms have the potential to increase efficiency, reduce costs, and democratize the access to the financial services. On the other hand, they also introduce new risks: market volatility, cybersecurity threats, and concerns over consumer protection. All those must be carefully managed in the financial ecosystem. As we witness the rapid growth of the blockchain technology, as the regulations, especially for the last 8 years, we have been facing the challenge of crypto assets. Crypto assets are reshaping the traditional finance. However, with this potential, there comes the need for greater understanding, regulation, and responsibility. When we come to Turkey, Turkey's first significant encounter with crypto assets occurred toward the end of 2017, during the Bitcoin price rally. At that time, the intense public interest for the trading of crypto assets made it clear that the developments in that area could not be ignored. Subsequently, institutions such as Capital Markets Board, Central Bank of Turkey, the Banking Authority, and the Anti-Money Laundering Authority, MASAC, and the Revenue Administration convened under the leadership of the Ministry of Finance. As you know, at the early of 2018, there was no global clarity on how the crypto assets should be regulated. Furthermore, there was not even a uniform definition of the crypto assets. As a result of the initial tasks, it was decided to closely monitor the market, the developments, and to warn the investors about the uncertainties surrounding the crypto assets and their trading. Accordingly, in January 2018, an official announcement was issued setting out formal stance of the matter. In the meantime, global developments in the field were closely followed. I don't want to go too long, but I have to mention the studies of Financial Stability Board, the IOSCO, the International Securities Regulator, the FATF, and the European Union. These studies made our vision more clear on the aspect. During this period, legislative drafting efforts were launched to respond to the evolving landscape of the crypto assets. There were various alternatives brought on the table regarding the scope that the draft law should cover. In fact, there was considerable confusion on several key issues, such as what should be the scope? Should a general law be enacted to regulate the entire universe of the crypto assets? Or should we remain within the boundaries of the existing legal framework based on the specific characteristics of each asset? Should the capital movements be subject to some limitations? Considering that the crypto assets are easily transferable, should certain restrictions be introduced for the trading platforms? And how should the taxation be approached? These were just some of the various points that we discussed. Throughout the discussions, the European Union's MiCA draft served as a significant point of reference for us. Moreover, the IOSCO's technology-independent approach and its same risk, same regulation motto greatly contributed to clarify our perspective. In this context, the first legislative regulation at the statutory level was enacted on 2024. Rather than enacting a separate dedicated law specific to crypto assets, the regulation was introduced in the form of an amendment to the capital market law. Because the main goal of the law was to regulate the trading platforms and other virtual asset service providers. I will call VASPs from now on for the virtual asset service providers. Although referred to as an amendment, it actually involved the addition of many new articles in the existing law. You can see the basic structure of the law on the next slide, if you can. What did the law bring? First of all, the definitions of crypto assets and other related terms were made. This marked the first time crypto assets were defined under a statutory law in Turkey. There were also other definitions, such as crypto asset service provider, crypto assets custody service, trading platform, and wallets. But the definitions were limited to this. Because at the statutory level, we kept them limited because this is an evolving field, while it would be possible to include more detailed and deterministic definitions in the law. We could have translated from the MiCA or anywhere else, but doing so could have constrained us in the future. More detailed definitions were introduced through the secondary legislation. Then it comes to the main body. The main body of the law covers the virtual asset service providers' licensing and operating conditions. These include, but not limited to, establishment of and operational requirements, information technology infrastructure, internal audit units, listing principles, and requirements for fair price formation. When we look at the IPO side, the law does not explicitly regulate the issuance of crypto assets. Instead, the law regulates the issuance of the capital market instruments. In other words, crypto assets that provide rights specific or similar to the capital market instruments are subject to the capital market law. Besides, authority granted to the Capital Markets Board for the issuance of Layer 1 coins, that we call them as the technology coins. Other crypto assets are excluded from the scope of the law. They are excluded, but can be listed if they fit in the listing criteria of the platforms and the listing criteria, the general listing criteria that we determine in the secondary legislations. If the issued asset falls in the scope of another regulatory authority, for example, e-money, a crypto asset, you issued a crypto asset representing e-money, the issuer is responsible to the other authority and the other related authority and the proper law and regulations. The law also defines the custody business. Banks and other institutions to be authorized may offer custodian services. According to our secondary regulation, which I will explain briefly later, we are trying to separate the entities for trading and custody. In other words, trading platforms should work with a separate custodian to keep their customers' assets. Finally, but absolutely essential, the law also includes cautionary powers, administrative fines, and criminal sentences. In the next slide, I have also mentioned what the law does not regulate. We don't regulate all types of blockchain-related work and activities, but as long as it's not offered to the public, offered or sale to the public, and not subject to trading on the trading platforms. Also, mining, personal wallets, NFTs, and capital flows are excluded from the regulation. The law introduced a transitional period for currently operating virtual asset service providers. As of today, there are 88 VASPs listed currently operating, while the number of companies that were declared the intention to liquidate stands at 17. The secondary regulations under the law were developed and finalized in cooperation with all relevant stakeholders, including the Banking Authority, TÜBİTAK, the Scientific and Technological Research Council of Turkey. We work very closely with TÜBİTAK, and the Financial Crimes Investigation Board, MASAK. There are 2 communiques as the secondary regulations, which it was issued by the Capital Markets Board on March 2025. The communique on the establishment and operation principles of VASPs, and the communique on the procedures and principles of VASPs activities and capital adequacy. The CMB's information system communique was also revised considering the VASPs. Basically, these regulations can be interpreted as the application of basic traditional finance principles to the VASPs. For the blockchain-related matters and issues, TÜBİTAK, the Scientific and Technological Research Council of Turkey, has declared the standards. These standards include even hardware, software, case ceremony standards, and etc. During all those processes, we work very closely with TÜBİTAK. I would like to briefly mention the topics you can find in the secondary regulations. First, the principles for the safekeeping of client cash and crypto assets and customer asset segregation. The recording of client orders, handling of customer orders, and maintenance of their logs. The circumstances under which crypto assets fall within the scope of the law, as I explained previously. Rules on advertising and promotional campaigns, data transfer requirements to the Central Securities Depository, the prohibition of the leverage and margin trading, the control and management of wallet private keys, the personal employment requirements, the principles of outsourcing, document and record keeping systems, listing principles. Actually, listing is mainly on the authority of the relevant platform. Capital adequacy requirements, we also drafted in the regulation. Audit for proof of reserves. And there are many other issues that we have drafted in the regulation that I don't want to mention it to keep it short here. By adapting traditional finance principles to VASPs, as I said previously, investors will be given the confidence for the new market. The regulators will have the opportunity to monitor and supervise the markets more closely. End of June is an important day for the Turkish regulation because it's the deadline for the VASPs to fulfill the license application to the Capital Markets Board of Turkey. Any company who could not apply with the necessary conditions in the communique, for example, the minimum capital requirement, which is 150 million Turkish liras, should quit its activities. At the end of December, the trading platforms should sign an agreement with a custodian to keep their customers' assets. Finally, at the end of June 26, the licensing period for the existing virtual asset service providers is supposed to be terminated. During this period, of course, new applications to the capital markets boards can also be made. The thing that I said was for the existing virtual asset service providers. For a future perspective, the new regulatory environment is expected to constitute a more predictable and safe market for all stakeholders. Regulating crypto assets is a critical step toward ensuring their sustainable growth and integration into the global financial system. Thoughtful regulation can provide clarity, protect investors, and mitigate risk without hindering innovation. Striking this balance requires close collaboration between policymakers, regulators, industry participants, and technologists. As the crypto landscape continues to evolve, adaptive and forward-thinking approaches will be key to addressing emerging challenges. Our aim is to create a regulatory framework that fosters trust, innovation, and long-term value. Lastly, I would like to thank for your listening and participation to Istanbul Fintech Week. Thank you.